The Marketplace on BFM 89.9.
Good morning. I'm speaking to John Goodall, the CEO of online peer-to-peer lending platform Landbay, about the benefits of this particular type of lending model.
Peer-to-peer lending means that basically the bank or the intermediary is cut out, and peer-to-peer lenders like Landbay connect people that want to borrow money directly via the platform to people that have money to lend. So that way, borrowers can normally get a slightly cheaper rate, and lenders actually get a better return for their money. So they are lending directly to an individual or a company, or in Landbay's case, against a mortgage or a property.
So when you say cheaper rates and better returns, what kind of better returns are we looking at for investors?
Well, so it does depend on the type of lending that you're doing. So in the UK at the moment, and Landbay operate only in the UK at the moment, interest rates obviously in banks are about 0.5%. So if you have money to save, you typically get around about 0.5%. If you're lucky, you may get up to 1%. Now, on peer-to-peer lending, depending on how long you're prepared to commit that money for and the type of lending and the type of risk, you can get anywhere from 3.5% to about 6 or 7%. The lending that Landbay does is very low risk. It's against mortgages, residential mortgages, and so it's secured. But lending to businesses where there's a bit more risk, if the business goes bankrupt, then you can typically get higher rates, maybe 6 or 7%.
What kind of relative risks are there, and are there safety nets in place for investors?
There are two main risks that people should consider. One, obviously, is that they are lending themselves, so their money is at risk. This isn't covered by any banking compensation scheme like savings accounts would be in the UK. In our case, these are mortgages, so they're secured. So if the borrower defaults on his payment, we can take control of the property and sell it, and that way return people money. In addition to that, we have a sort of fund, a sinking fund. On every loan, we put a little bit of money into this fund, so that again, that helps to provision. And some other platforms also run these, what they call provisioning funds or protection funds or safeguard funds, where a little bit of the margin on every loan goes into a fund, and so if there is a default or a loss, then this will cover it. It's not always the case. Not everyone does it, and it's not guaranteed. So that is obviously the main risk, the loss of capital. And the other risk, of course, it's not necessarily liquid. And so that people have got to be prepared to sort of tie their money up for 3 years or so. And while you can get money out early, it's not guaranteed. So obviously in a bank, you typically get instant access, or after a 30-day period, you can get it out. Whereas with peer-to-peer lending, yes, you can, and typically on Landbay, if people want their money out, they get it out in 48 hours, but we can't guarantee that because it's dependent on someone else coming in and taking their loan part.
And John, do you think that this peer-to-peer lending model could work in a market like Malaysia?
I think in theory it can work in any market. I mean, there are more peer-to-peer sites in China than in any other country in the world. I mean, the regulation is slightly different in every market, so the models may be different. But yes, there's no reason why it couldn't work anywhere. All it requires is people that want to borrow and people that want to lend.
If you're interested to know more about Landbay and peer-to-peer lending, John Goodall will be speaking at the World Capital Market Symposium on the 3rd and 4th of September, organised by the Securities Commission.
The Marketplace on BFM 89.9.